hello from Canada. Cool.
Sweet.
Okay. Shall we transition then?
Yeah, let's do it, Mark.
All right, cool. I'm going to switch over now. Let's see if I think this will be a lot of fun. I'm going to start my timer for myself. Keep an eye on it with me if you don't mind, Sean. Shout at me if we get to close to 25 minutes. I'll try to get through everything we've got to cover here. I'm going to hit start sharing. If you don't mind, guys, again, as you're going through this, there's going to be some questions. If you're a living, breathing human, you're going to have questions as we go through this. So I can't wait to see your questions, and then we'll make sure we spend some time at the end answering. But can you hopefully see my screen, Sean, the title slide? Okay, great. So there we go. Okay, so let's get going. If you guys have to remember one thing, go to bit.ly/startbanking, bit.ly/startbanking. And Julia, would you mind to put that in the chat if possible? That's just a way for us to connect and talk after today as we get through this conversation. If you remember nothing else, go there. If you can remember two websites at the same time, go to our membership site. Sean and I are both members, and so we can keep the conversation going as it relates to the topics we've covered together today by going to this website, notyouraverage.mn.co. So please make sure that that's on your radar as well as the previous bit.ly/startbanking. I'm going to put this other disclaimer up. We've already talked about it, so I won't bore you guys to tears, but our attorneys are so happy that we included these slides, right, Sean? I mean, this is the best and most important slide for our friends, our wonderful attorney friends. Yes, right. we are not giving you investment advice or tax advice today. And of course, you're taking on the responsibility to invest, which is why I love it. I love that you guys are taking the responsibility to invest. I feel like in many ways, Sean, one of our very interesting first conversations was the kind of the reality of passive index funds. And, I think, the data supports that passive index fund investing underperforms the market. And you're showing us a way, no guarantees, of course, to beat the index funds with regular consistency, right? So let's keep rolling. One of the things that I find when I meet with folks all across the country over Zoom and telephone calls and more is that most people have a financially upside down financial life. Their safe and liquid money is small in proportion to what's illiquid and at risk. So over the last 3 to 5 years, have you needed your roof replaced? Have you needed a new car? Have you had an adult child or an elderly parent need some financial assistance? What about a large tax bill? What about a car repair? What about a job loss where you had to go a couple months without a paycheck? If most of your money is in things that you cannot access without penalties and taxes, you have an upside down financial pyramid. And I don't know about you, but I wouldn't sleep very well at night at the bottom of that pyramid, Sean. So, the key piece, of course, is, if you don't have cash, what are your options? You can do only a few things. You can pull it from your home equity, as long as a banker is willing to lend it to you, credit cards, personal loans, sell your inventory if you have a business, and withdraw from these wonderful ticker promoted accounts, which is the worst time to take from your investments, right? Sean, when are our stocks most likely going to be taking a beating? During good times or bad times?
Bad times.
When are we most likely going to need cash? During good times or bad times?
Bad times, right?
And when is a banker least likely going to let you borrow money?
Bad times.
Bad times. So it's a tornado. Back to this, looks kind of like a tornado on us too, right? So our key piece here is build a financially stable pyramid where we have an almost uncomfortable amount of safe and liquid cash. I say almost uncomfortable because I still want it to be sleep well at night cash that's safe, predictable, and liquid, and take risk with money you can afford to lose. When I use ticker, I'm using the money I can afford to lose in that part of my financial portfolio. So where does the rest of my cash go, and how do I access that cash for investing, which is what we're going to be covering today. Everybody on this call, if you have money in an account, like a brokerage account, Sean, you said it was Ameriprise or TD Ameritrade?
TD Ameritrade is what I use.
Okay, right on. So whether it's TD Ameritrade or Schwab or Robinhood or any other ones,
Right.
you've got to have, well, hopefully not the last one there, but but you've got to have a cash account, don't you? You need a sweep account in order to be able to make these purchases and more. So we're going to be talking about where to stash your cash with our time together today. There's only a few options. You can put it under your mattress. There's not a lot of security there. You know, if anyone else finds out where the money is, there's no interest under the mattress. Your savings account, about the same, right? Now there's some good pieces to it too. You can set up auto transfers to your savings account. CDs are taxable every single year. They do give you a little bit higher interest, but then they take some of it away when they tax you. At least in the United States, the certificates of deposit are taxable every single year. Then, of course, we've got money market accounts where a lot of us keep our brokerage cash. It does earn some interest. It is higher minimums needed and a limited number of withdrawals that you can take against that MMA each year. You can't just be grabbing it for groceries every week. Then you've got money market funds, which are relatively safe. You know, there's some pieces that do give you some higher interest, but there's no insurance, no FDIC insurance on MMFs. Then there's something we call bank on yourself designed whole life insurance. Now, whole life insurance is sort of an anathema to a lot of people. It doesn't feel like it should fit onto the cash side of your balance sheet, but it absolutely is. It's a strong asset on your balance sheet if it's designed the bank on yourself way. So as I describe this, kind of just picture in your mind how this might fit into everything Sean just described. I really do believe it's not either or, it's both and, which we'll get to in our discussion today. So insurance and investments have, I don't know if this is insider baseball or not, but a lot of times the insurance industry and the investment industry have sort of been, you know, whatever, they've been at each other's throats. And there's probably reasons why. I have a feeling it has something to do with, you know, advisors and commissions, and every dollar that goes to insurance is a dollar they can't put under their management and get a fee for, and vice versa on the insurance side. But that's for another conversation, Sean.
Right.
So what is whole life insurance designed the bank on yourself way? Well, it's a blend of life insurance and savings. It's a permanent insurance that provides you with coverage and cash for your entire life and beyond your life for your kids or charity. It does earn compound interest. So there's a savings component you can use for the purposes of anything in your life, car repair to investing in the stock market. So by using this tool, you have a earned compound interest, which is higher. In many cases, it's 500 times greater than what savings accounts are paying today. So middle single digit returns. And there are no volatile years. This is a predictable, productive, safe, and even the word guaranteed, there's the word guaranteed asset to grow for us every single year for the rest of our life. And of course, it does provide for those retirement living benefits. You can use this as a stream of income in your retirement. Now, it does increase in value every single year. No markets required, no risk involved. If it was on the risk spectrum, it would be a 1 out of 100 in terms of risk. So for those very cool, very interested, very savvy investors aware of the efficient market frontier, you know, this is the risk-free asset on the balance sheet. So we can go find additional risk assets by finding and picking and choosing among the ticker symbols. So that's the concept here. So we're increasing our cash value on a guaranteed basis, beating inflation every single year. It's in the contract that it will grow on a guaranteed preset amount. And on top of those guaranteed returns, there are dividends paid. Now, dividends are not guaranteed, but the dividend has been paid consistently with the companies I would recommend for the bank on yourself designed whole life insurance. Dividends haven't been missed in over 100 years. Now, anybody on this call who's familiar with dividend investing, you know, like who here would be a dividend aristocrat investor? I can't find many, maybe there's a few, of stock companies that are dividend paying without fail for over a century. That's pretty remarkable. Now, dividends on life insurance companies are slightly different and taxed very favorably relative to dividend paying stock, but we'll get to that in a moment. Okay, so what about access to cash? If we're going to use this like a sweep account for our investments, and heck, for the rest of our financial life, I'm going to need access to this money. So one key piece is you can access via withdrawal or borrow. So you can loan against the cash value and borrow up to 85% of the money or more. Actually, 85 to 90% of the money can be accessed as a loan at any time below market rates. And the key feature here, which has floored me since I learned about this almost a decade ago, is that the policy itself does not stop compounding its growth. In other words, the money will continue to earn interest as if there was no loan against the policy. Okay, so the loan interest goes to the general fund, which are a part of the dividends that are paid to policyholders. So imagine if you had your policy growing at a compound rate, let's say you had $100,000 in cash value in one of these policies. And let's say you borrowed out $30,000 to go buy a car. We'll start with something simple like a car. All right. Now the policy continues to pay you an interest and a guaranteed interest and dividend on the full $100,000 as if there was no loan, and you're driving your Tesla around town. If you can buy one for 30 grand, I guess. Maybe after the next earnings call, we'll be getting Teslas for 30 grand. What do you think, Sean?
Right.
All right.
I think new models are becoming even more affordable. So
Is that right?
That might be close. Yeah.
In fact, on our membership site, we have just literally dropped today a video of us interviewing a gentleman who used his policy to go buy a Tesla. Just so happens. Now, I'm not telling everybody that that's the first use of this tool. The first use of this tool is to access the cash value for maybe more productive projects than buying a Tesla. How about buying real estate?
Right.
Other things that produce assets on your balance sheet. Okay. So there are some very important things to keep in mind here. There are lots of kissing cousins to what we're describing. Variable life insurance, universal life insurance, indexed universal life insurance, term insurance. All of these tools are close but no cigar. It does not work with any of these tools. So if you happen to have life insurance, think you might have a bank on yourself designed policy, look carefully at your contract and make sure that none of these words appear on your contract. Okay. Now, I'm not saying that whole life insurance is squeaky clean either. There's some downsides, some considerations to consider. They are also, just like value investing, it's meant to be a long-term financial strategy. I'd say the longer you keep it, the better. I wrote 10 years here, but maybe 7 is the minimum. But I hope to hold mine for 70 years. When do if I'm getting compound growth on my cash guaranteed, when do I want to stop that compound growth? What's Charlie Munger say about compound growth? Uninterrupted. How often should we break compound growth? Any guesses on that, Sean?
Well, one of my favorite quotes, and I think I mentioned this to you in the past, is it's not in the buying or selling, it's in the waiting. And he's a big proponent of being patient. You're going to have to wait. Patient
capital. Yeah. Patient capital versus impatient capital. If you are impatient with your capital, there's some swampland in Florida we can tell you about. There's just kidding. This is about patient capital. This entire webinar today is about patient capital. Very cool. Good. So what is the goal of your money? That's maybe the first slide. It could have been the first slide in our discussion today for both of our webinars, right? For both of our discussions. What's the goal? I don't know. If your goal is, again, to make $1 million tomorrow, there's some lottery tickets. I heard someone won the lottery last night. So if that's your goal, lottery tickets are great. But if your goal is long-term, uninterrupted, systematic, and passive income for the rest of your life, whole life insurance is amazing. There's no sequence of returns risk. Stop me if I need to define that, or somebody write, hey, what is sequence of returns risk? Write that into the question box, and I will be sure I answer that if we have time. But Google it if we don't have time. No sequence of returns risk. But let's talk about it. Let's use Vanguard's retirement income calculator to really decide what is the strength of whole life insurance when it comes to retirement income, if that's the goal of your money. Here's an example, a real live example of a whole life policy designed for retirement income. And if I can illustrate this, let me just kind of I know there's a ton of numbers on the screen, so let me just draw your attention to these. These are the contributions, also known as premiums, going into the policy. Okay. And over time, it will build up a cash value. There's a total cash value column on this in the middle of the screen. The total cash value grows. If you get down to age 65, he's at $1.2 million of cash and a death benefit of $2.8 million with no market risk. Okay. The year before he retires, what's it doing? The cash value itself grew by $85,000 was the annual increase of cash in the year before he retired. That's amazing with no market risk. Okay. And then he starts to take $62,000 a year from age 66 to age 100. So I want you to keep that number in your mind, 62 grand a year from age 66 to 100. Now, what would Wall Street need to do to match that? Let's look at the returns. Whole life insurance has modest single-digit returns. If you did an IRR calculation on that previous slide, which I welcome you to do, it'd be in the middle single digits, okay? But let's do the math. If I'm 40 years old and I use Vanguard's retirement calculator here, this came right off their website, and I invested 25 grand a year for 25 years, the exact same as what we showed on that whole life chart in the previous slide. And then I started to take 62 grand a year out of the retirement brokerage account. I'd need a 9.1% annual return for my entire life with no volatility. I couldn't go up and down and up and down. It'd have to be a straight line projection from day one till the end of my life to age 100 with no taxes due on that money either somehow. If you add taxes, we're talking double-digit returns that the market would have to produce for us. So, I was floored by that. But I believe at the bottom line of all this, whole life insurance is surprisingly, incredibly powerful in terms of retirement income and liquidity, tax advantages, and of course, it is life insurance. So it's a powerful estate planning tool as well. Right on. But some people say, well, Mark, okay, are you telling me that I should do whole life insurance, bank on yourself, this bank on yourself thing, and just forget about stock market investing? No, of course not. Not in the least. If your buddies have been saying, hey, you should invest in the market instead of this bank on yourself thing, or hey, you should invest in real estate instead of this bank on yourself whole life insurance thing, usually the words, hey, Sean, you should buy term insurance and invest the rest. That was a quoted phrase for about 40, 50 years, made very famous by a few radio personalities and more. You should buy term insurance and invest the rest. What does that actually mean? Buy term insurance and invest the rest. What does that mean? It means instead of buying whole life insurance, you buy some term insurance, okay, for a cheaper amount, and then whatever the difference is, you go and invest that. That's what buy term and invest the rest means. Now, most people, Sean, buy term insurance and then go out to eat, or buy term insurance and go to Disney World, right?
Mm-hmm. Yes,
but if we truly invested the rest, what would it look like? And does it really work? I had a client call me the other day. He'd paid his first year's premium last year, and then his second premium was due, and he reached out to me and he said, you know what, Mark, I've been thinking about canceling this bank on yourself whole life, and I just want to get some term insurance because I want to protect my family, but I want to be in the market. My first reaction to that was, oh, man, I must have missed something. One, because we had set this up a year ago, and time passes and we all forget why we do things. I know I do. Heck, I can walk into the food pantry and forget why I was in there. So, sometimes you just forget why you're doing what you're doing. And I don't often hear everyone clearly. So I took it upon myself to just say, all right, hey, this is not either or. It's not either I get this whole life policy or I go invest and get ticker and get these incredible, what'd you do in 2020? What was the yield? 80%? Did I see that right, Sean?
120.
Holy smokes. 120 in 2020. I like the ring. I like the sound of that. That's incredible, man.
That way. Yeah.
Yeah. And just like Sean, this client of mine was a true investor. In other words, he wasn't just throwing money into his, target date fund, which I call amateur retail investment products. You guys, all of you here, if you're here, you're a true investor, meaning you're learning the stock value. You're understanding the real value of the company that you're buying. So this is what he is one of you, is what I guess want to say, one of us. So in this guy's case, he was 42 years old. He was putting away $3,000 a month into his whole life policy. All right. Now, maybe that would floor some people to even hear that come out of someone's mouth, but that's what this gentleman was doing. And as you can see, at age 65, he'd have $1.2 million. Now, when I asked him, I said, well, what could you get in the market? He said he could absolutely, without batting an eye, just, wake up and get 8% a year in the stock market. Okay. Mm-hmm. Now, to do that, he'd have $2.3 million after the same period of time. So if you noticed on the previous slide, he had 1.2 million of whole life cash value. Let me go back to it. Whole life cash value at age 65, if you see it there at the bottom of the screen circled, is 1.2 million bucks. Now, if you were to do the same in a stock portfolio, averaging 8% a year, that's 8%. That gets you up to 2.3. Now, which is bigger? Which of those two numbers would you rather have, right? That's a no-brainer. Right. Let me go get my market portfolio and dump this whole life thing. But does he really get 2.3 million? And the answer is going to vary from person to person, but 2.3 million is not what you end up with. Remember, a giant chunk of that is a partnership with the IRS. Sean, what do you get when you put the words "the" and IRS together?
I think of IRS taking my money away.
Yeah, right, yeah. Well, yeah, when you spell the word "the" and IRS, you get the word "theirs," right? Yeah, so part of that money, holy smokes, did I go all the way back? Here we go. There we go.
And we're at about 2:30 here, just to...
Okay, got it. So I got about 6 minutes, looks like. Okay. So we got taxes due, 25% bracket is what he was in. 1.5% fees based on the way he was managing his money with his broker and his investment advisor. He had to buy some term insurance. Okay, so some of that money can't go into the market if we're going to compare apples to apples. He needs a term insurance policy and no cash access to the money. He needs ironclad discipline for the next 25 years. Okay, cannot touch the cash, no emergencies. So the final answer is he would not have 2.3 million. He'd have just shy of $1 million, 959,000. Okay, here's the math on all that. If you lay the whole life insurance policy next to buy term and invest the rest, notice about year 6, at the beginning, the term insurance and investments are beating the whole life insurance cash value, if you see it there. But around year 6, I circled the number. That's the year that whole life insurance on these assumptions start to exceed what the term insurance has. So back to patient capital. Okay, so over time, how long do we want our money growing? And even on a guaranteed basis, the guaranteed cash value beats the investment account by year 12. And by year 21, at age 63, well, let's see, at age 63, his 20-year term insurance expires. So his $2.6 million gift to the family, I'm circling it here, dropped like a stone to only leaving what he could leave his family in the brokerage account, $846,000. So at age 65, when we're at the end of the story, he'd either have $959,000 in the investment account or $1.2 million in the whole life. Okay, so either he can end up with $1.2 million with no market risk and fully liquid cash value with a $2.9 million death benefit, or buy the term and investments and end up with $959,000 at 8% with no guarantees and have $99,000 paid to term insurance with zero to show for it. What's that old song? I got 99,000 problems, but term insurance ain't one. I just made that up on the fly. I hope that's right.
Yes, you did.
All right. So I won't spend too much time on volatility. I think you guys get it. You can go up 10% this year and be down 10% next year. You're not actually even. If you go up 10% this year and you're down 10% next year, you actually lost money over that period of time. Averages don't mean anything. And the stock market S&P did 5% from year 2000 to 2016. But if you were to put $100 into a brokerage account over that same period of time, your real return would only be 3.35%. That's the problem with volatility. And this is a picture of those numbers I just gave you. Volatility vaporizes our returns. So in our final moments here, I'm going to describe a better way than buying term and investing the rest, and even buying whole life insurance alone. So we're about to blow some people's minds. It blew my mind when I was putting all this together. So I hope it's fun for you guys too. So what if instead of buy term and invest the rest, our famous radio host would say, what if we bought whole life and invested the cash? Like the little turn of phrase there. So imagine, what if you could borrow from this policy and it continued to grow for you, uninterrupted? And then you took that money smartly, and instead of buying a Tesla, you invested that money into things that you knew and understood. The stocks, the market, your business, real estate. This is where I think ticker and this policy go hand in hand. Right. Because if you have the power of insight that ticker allows you to have, it gives you the knowledge to make smart investment decisions, which reduces your risk. And then you've got a policy which, no matter what happens in the market, your policy will grow compounded even on the cash you borrowed to invest. So watch your numbers soar when we do this, guys. Here are the 5 steps to using your bank on yourself type policy as a sweep account for your investments. Hope that concept translates. I don't know if sweep account is international, but you get the picture. It's the cash holding between your investments, okay? So the steps are very simple. 1, whole life policy. Fund that whole life policy as aggressively as you want to. Step 2, take loans to invest in the market each year. Step 3, the policy will continue to grow even on the capital you borrowed as if there was no loan. Step 4, when you're ready, you can pay off the policy loan as you sell your investments. And step 5, you can enjoy a stress-free retirement. You guys want to see how that works? I bet you I can do it in 3 minutes.
You got this. Do it.
All right, man. Step 1, $3,000 a month goes into the policy. Here we are, guys. No loans. This gentleman has no loans for the life of his policy. He just lets it sour inside the policy, and it still grows to 1.3 million bucks. Remember that number, $1.3 million. Okay, good. Step 2, instead of just letting it sit in the policy, let's borrow against it and invest the money at 22,000 bucks a year, starting in the second year, going out through age 65. So for 22 years. And let's assume that he gets that 8% yield. That will grow to 1.3 million bucks, which is just serendipitously close to the whole life cash value we just saw, but no relation. Okay. Now that number 1.3 is before taxes and no fees on the money at all. So we're assuming no taxes and no fees to get you to that giant number. Now, what we're looking at right here, guys, is him taking a $22,000 loan against the policy for all these years, from year 2 to year 23, to invest into the market, which is what those red lines are on this slide. Still clear on everything so far? So we're taking whole life cash value and investing it in the market on a regular and consistent basis. Now, in the final year at age 66, he takes $889,000 out of his brokerage account. I'm not telling everybody to go do it that way, but you could take all your money out in the final year. Let's say it was a capital gains holiday that year, Sean. You could take all your money out, wipe out the policy loan, and the only thing I wanted to show you guys on this slide is that no matter how or when you paid that loan off, notice the cash value, 1.32 million bucks. Now, where have we seen that number before? That's right. The policy continued to grow as if there was no loan on this policy for over a 20-year period. Remarkable.
I like it.
Okay. So we paid off the loan using the investments, but we still have hundreds of thousands of dollars left in investments. Okay. And the final piece here is take that money out of the investments, wipe out your whole life. Policy is whole as if it never had the loan against it for all that many years. So let's do the math on that.
Yes.
You got total available in retirement is 1.3 million from your whole life policy, which is tax-free, by the way, tax-free money, plus another 321 grand to grab as you'd like to go see the grandkids and whatnot over your retirement years. That's a $1.6 million retirement. Most of that's tax-free from the whole life and a lot of guarantees built in. Okay, so I'm going to skip over this. This is kind of the bottom line. If you combine both of these, including the death benefit, we've got a whopping $3.9 million family value between your money and your kids when you pass away. All right. Obviously, there's some pieces to the puzzle. This is not a debit card type account. There are insurance costs as well. So it takes some time to grow your cash, and it does take a few days to get the money out. So, plan accordingly over the next couple of days and then make that purchase. It's not instant. Really, this is about writing hard and diversifying. And when you think long range, you think toward the success of your entire financial life, not just, this Saturday's rate of return. All right. So I'd say, again, key piece here, don't end up with just someone who maybe Googled this. Your investment advisor doesn't know. Quite honestly, they don't know about these type of whole life policies. So be aware that if you're bringing this strategy to them, that's a warning sign that they probably don't even know as much about this strategy as you do at that point. So again, as we wrap up, thank you guys. Be very happy to answer questions. I tried to go fast, but not too fast. But again, if you'd like to chat with me about how this might incorporate into your overall financial strategy, I am a certified financial planner and be happy to talk with you about how you can bit.ly/start banking, as the website says. Sean, I'm off my soapbox, my friend. Thank you.
This is great. And just to the listeners out there, I've been exposed to whole life insurance policies, numerous different products, you could say, prior to meeting Mark. And this one really did pique my interest, especially the math at the end. You pay off what you owe to the policy, but you look at what you made and then add that to how the policy grew over the years. That's, when you show that compared to the buy term and invest the rest, it's significantly better. So nice work, Mark.
Thanks. Appreciate it.
Yep.
I
dive into
have
Q&A
the
here.
Q&A. Yeah. Sean, why don't you roll with the questions, or Julia too, whatever you guys would like.
Sure. I'm starting here. I did see a question from John. I want to ask, here we go. What is the guaranteed return rate per year on whole life insurance on this product?
Yeah, good question. Again, the think of it almost like a cash equivalent in your portfolio. I regularly tell folks it's not meant to replace your investments. I have seen the yield on these policies in the middle single digits. So I've seen them as low as 3.5% and as high as 6.5%. Now keep in mind that's after fees, expenses, and taxes that return. So to get that in a brokerage account or a 401k, even worse, you'd have to incorporate fees and taxes to your 401k's return to compare the two. But like I say, I don't see them in the same universe. Whole life insurance is not an investment. It's a savings bucket and can be used for your investments. So short answer, 3 to 6% is very common in these type of policies, depending on how they're designed.
Great. All right, another question here. In Comio, sorry if I'm slaughtering your name there, but the question is this a US only concept? And that's something I did talk to you offline. So who is this available to outside the States?
Well, great question. The short answer is the best whole life contracts are in the United States, as far as I'm aware, and Canada. So Canada has some incredible contracts that are like and even better than some of the stuff I see in the insurance space in the United States. If you have ties, such as a business or a family member or a residence in the United States, you may have a contract in either the United States or Canada, even if you don't, live here all year long. So talk with me. The details are always, the devil's in the details as always. So I've got clients that live all over the world, and then they'll visit the United States to check up on the real estate properties here. And they've got several policies. So it just comes down to the details.
Right on. This next question may be a little technical, may require an offline answer, but Peter asks, what is the arbitrage? Loaned money versus earned interest?
You're right. That would be a detailed question, but I can give you some basic ideas. Guys, let's use $10,000 as an example, because I've done the math on this one enough to have those numbers memorized. But we could run the math on it for sure, Peter, one-on-one. Just go to the bit.ly link I have on the screen, we can do the math there. But if you'd borrowed 10 grand, okay, and let's say you paid it back over 4 years, you'd pay about $700 of interest. Okay, so keep that in mind. 10 grand you borrowed out, you paid back $10,700 to fully wipe out that loan. Still with me on that, Sean? Did that make sense to you?
I'm following. Yeah.
Okay, so that works out to about a 1.9% APR. 1.9% APR. Now your policy continues to grow and build on that $10,000 as if there is no loan on the entire $10,000, even as you're monthly paying back the loan. So over that same 4-year period, let's say the policy was doing 5% a year, that's about $2,000 of gains over 4 years, compounded. Grab a financial calculator, you'll see what I mean. So what did we do? We accessed the 10 grand, we paid 700, and we got back 2,000. So there's a spread there. The arbitrage is $1,400. Am I doing my math? No, $1,300 at the end of the day, right? We came out ahead $1,300. Now, if we hadn't borrowed the money, we'd have had all $2,000 of gains, right? So the key question is, did our investments earn more than $700 over 4 years? Because if they did, not only did you get the 2 grand out of your policy, but you also had a productive asset, whether it was your Tesla stock or what was it, NVIDIA?
Right. Yeah.
Now, the other key piece to this is there is no required repayment plan, Peter, and Sean too. Yeah, anybody listening, the policy has no required repayment plan. If I want to, I can wait till that stock is the perfect price before I sell it. And my policy is not demanding a monthly payment. Unlike a HELOC or a 401k loan or a credit card, there's no monthly minimum payments. In fact, if I just took this loan all the way to my grave, we just saw the gentleman on that spreadsheet there, he went 20 something years without paying off his loan. But if he had gone his entire life and then finally croaked, the death benefit would simply be reduced by the loan balance. And his family would get to keep all the stocks that he had never sold over those many years. And he'd have a big net death benefit after factoring in the policy loan.
Gotcha. No, good question. Good answer.
Yeah, great question, Peter.
All right. Just a heads up here. There's a few rapid fire questions here from John, and we should hit on those. But there are a few that relate to ticker again. Let's
do those too.
To share.
Sure.
So let's hit some of John's here. He's got a good one here. It says, so we take a loan from the policy, invest in the market over a period of time. What period of time would you suggest? And I think that more applies to your, like, what kind of time period would we look at with your policy?
Oh, I mean, time horizons are yours, guys. Are you retiring? When do you need the cash? What do you need the money for? I think with value investing, it's not a 2 weeks kind of turnaround time, is it? Right? We're maybe months, years, right?
Right.
So, maybe you let the policy loan grow, or maybe you pay it off with dividend checks from your stock portfolio or rental property income or other ways to pay off the loan, or just forget about the loan and just manage it passively. Again, there's no required repayment plan when you access this cash. So as you watch your portfolio, and when ticker tells you sell, it's overpriced. Like I saw Apple was overpriced, Sean. I don't know. What do you think? Is it time to sell?
Which it is at the moment, but I still hold it.
Good man. So let's say you decided, you woke up and you said, I've had enough. You'd sell your Apple stock. That's when you could pay off the policy loan. And what is the policy loan doing when you pay it off? You're just putting it back in a parking space. You're putting that money back in the policy to recycle it again when Apple's on sale or some other stock comes online, right?
Right. I've got another one. Good questions here. John and Peter have a few related to interests and whatnot. So I want to hit Peter's question. It says, is loan interest capitalized in the calculation or repaid annually?
Oh, wow. Great. Smart question. In my example, I'm assuming you're referring to the spreadsheet I showed, and guys on the YouTubes, make sure to rewind. You can go see rewind. Wow. That shows my age. Back up the video. You can see the, numbers. We're letting the interest compound in this case once a year. Now, this is a kind of cool feature for the technical folks on the call. policy loan interest is one of those rare financial birds in the universe that accrues simply. So it's simple interest all year long. I wish my mortgage was simple interest. Okay. So it's a simple interest loan all year long, and then it compounds annually in arrears. So one of the more favorable ways we can access cash. The cost of money goes down when you have simple interest. I wish credit cards were simple interest. So in your question, yeah, we're assuming that we're just forgetting that that loan exists for 22 years. I think it was 23, 22 years. It would be even cheaper if you'd paid that interest every year out of pocket.
Right. Here's another question. So from John, what are we paying in fees on a monthly and annual basis?
Wow. Okay. There are no assets under management fees with whole life insurance. There's no loan origination fees. There's no setup fees. The only cost is the delta between what you paid in premium and the cash values increase. So I'm going to just very, very quickly go back to the numbers to give you guys some idea of what I'm talking about here. So notice in year one, this guy puts in $36,000. See that? And then he has a cash value of 23 grand. That is that delta there is about 13 grand, I guess. That's the only expense in that year. There's no additional gotchas. It's what you see is what you get. So no one likes to spend 13 grand. What did it buy? It bought us the entire contract and all of what it does over your lifetime, including this $1.1 million death benefit. By year 3, I'll hush after this, I promise. By year 3 to year 4, I see the cash value growing by $36,400. Is that, Sean, do you see that on your numbers there too?
Yep.
So the increase of cash from year 3 to year 4 was greater than the $36,000 that the guy paid. So in year 1, yes, there's a negative cost. There's a cost to the insurance. But from year 3 to year 4, the increase of my cash value is $36,400. That's greater than the $36,000 even that I put into this policy, meaning the net expense is gone after the 3rd year. So there are no additional fees that are associated with these policies. No assets under management fees, none of that. So
I think that's a fear a lot of investors have, is what kind of AUM, as you just mentioned, assets under management, are you paying per year for this? Cutting into your profits, your returns, the whole deal.
Great. And for those that would like to keep the conversation going, I'd be honored to learn more and understand your story, what you'd like to do with your cash, your money, what your goals are. So guys, have fun. Thanks for being a part of this.
Yeah, thanks everyone. Thanks for joining. Great questions.
Bye.